So it has been an awful 2 years for Alibaba investors since the start of the crackdown back in October of 2020. From its peak, Alibaba is down around 75%, allegedly far worse than some of the growth stocks out there. It then begs the question, how low can this piece of garbage get? So before we start pounding on the stock and criticize how Chairman Xi doesn't know how to govern the country and allegedly being arrested in his house, if we were to zoom out and look at the broader index that Alibaba is listed in, which is the Hang Seng Index, the HSI is the most widely quoted barometer for the Hong Kong economy, and it is structured in a way to be kind of a market capitalization weighted index that has 8% capping to avoid any single stock domination of the index. And as of April 2022, there are a total of 66 stocks in the Hang Seng Index. So as of 30th September 2022, the Hang Seng Index closed at 7,222 points, and it's the lowest close since November of 2011. And that right there, I present to you, ladies and gentlemen, a lost decade of the Hang Seng Index. So the Hong Kong economy is in a very special place right now. And by special, I don't mean it in a particularly good way. Since Hong Kong is a special administrative region of China, it tried to differentiate itself with many peculiar and interesting characteristics. For one, the city's currency is actually pegged to the US dollar, and thus, it often ties its monetary policy to that of the US Central Bank. It has always strived to be the financial hub of Asia in the last 2 decades or so, hence allowing for the free exchange of capital, very much different from China. That said, a majority of its economy still relies heavily on China, and even down to the specifics of policy administration, like the zero-tolerance strategy towards the pandemic. So when the world is booming, there wouldn't be any issues with these sort of arrangements, because who's gonna care anyway? The problem comes when there is a dissonance between the two major economies when they are basically stress testing the one country, two system in real time right now. So you can do me a favor by stress testing the like button as well. I think the like button is having too easy a time, while the rest of us here are suffering. So remember to smash it into oblivion. Oh, I have good news by the way. So Weibo has recently extended their latest sign-up bonus rewards of up to $130 worth of Tesla shares for new users until the 14th of October. So all you have to do is to sign up for a new account with the link below and deposit at least 2,000 Singapore dollars and execute one buy trade for a stock or ETF and one option. And you will get an 8% return on investment from the sign up rewards. So Weibo prides itself on zero commission trading, so let's stop paying all the different commissions and use it to buy more Alibaba. For existing users though, feel free to get your friends to sign up using your own referral code. You can refer and win up to $6,888 worth of Apple shares. Details will be on the promotion page itself. I'm currently using Weibo for my 15,000 portfolio challenge, so don't let this guaranteed deal get away. Link in the description below. Now, if we were to compare the major indexes of the world today, you can see that there is a huge disparity in how investors are trying to value the different companies in the different geography regions. So I'm referencing this table from Dr. Wells' research. I'll leave a link to his video down below. So as you can see, on a PE ratio basis, Hang Seng Index is currently trading at 6.6 times, while major economies indexes like the S&P 500 is at 18 times, and the Financial Times Stock Exchange, which is basically the London index, is at 13.6 times. So if we don't look at the Western bloc, even Singapore's Straits Time Index is at minimally at 12 times, while China's local index, the CSI 300, is at 14 times. So what the heck is happening? I think it's safe to assume that most real Chinese equity investors, those that actually buy the A shares, are usually people or funds that are operating in China, because Hong Kong remains an entry point for those of us, especially international investors, who want to tap into Chinese stocks, but given the limited access. That said, however, when you dissect the individual equity positions of the Hang Seng Index, the top few positions are companies like Tencent, Alibaba, China Construction Bank, Meituan, HSBC, AIA, JD, etc. So all of them are strong Chinese businesses. Given the barrage of online commentaries, specifically on how and when the entire Chinese economy is going to collapse on itself, and how the entire Chinese population crisis is going to make China cease to exist, mainland investors, on the other hand, are still ascribing a 14 times PE ratio for their local stocks. But international investors that have access to the stocks in the same geography seems to know and understand more than those people inside. And I hope I'm not the only one that sees the disconnect. Side note, many of these Westerners are getting a little bit too addicted to this whole China/CCP collapsing porn. Some of you might want to get some sort of help soon. It's okay to not be okay. Anyway, I'll leave it up to you to decide whether this is an opportunity or a crisis of our lifetime. So for those of you who are slowly losing hope in Chinese companies, the CEO of Temasek Holdings, which is a Singapore state holding company owned by the Singapore government, remains bullish on China in the longer term. Of course, when you're in the business of stock picking, just because the country is good doesn't mean that your stocks will automatically deliver spectacular returns. Look at the US, it's a prime example. Go back to fundamentals, you need to pick good companies at reasonable valuation. So the million-dollar question is, how low can the market go? And why do you think Chinese stocks can recover in the longer term? So what happens if they model after the Japanese market and experience a second or even a third lost decade? So to answer the first question around how low can this market go, I'll answer it with great sincerity right now. Nobody knows. That said, if you look at it from a purely quantitative aspect, can the Hang Seng Index crash another 50%? Sure. Who prohibits the crashing of a particular stock market? No one. If it crashes to 8,000 points, that means that the PE of the index would become 3 times, assuming the earnings stay constant. So what does having a PE of 3 means? It means that it just takes 3 years for the companies in the index to buy itself back at the 8,000 points valuation. 3 years, by the way. Of course, you have to determine how sticky the earnings and cash flows are and make sure that the earnings are not one-off. And the same logic is actually applied to single companies that you are invested in. And the lower the valuations, the safer you would be generally. And of course, be extremely careful of value traps. To answer the second question on how sure I am that valuations will revert back to all-time highs, I wouldn't say I'm 100% confident, but I'm confident enough to back up my own predictions with my own money. I hope that's good enough. Just a clarification though, I put my capital behind individual names, not the broad-based index, because my assumption is simple. As long as I'm backing the right companies that can keep growing their free cash flows and also earnings in a meaningful way, investors can ignore this sort of investment opportunities for the short term, but wouldn't miss out on it in the long term. I can be wrong, and I have been wrong in the last 18 months or so. So don't just listen to me ramble on when I'm just a random dude on the internet. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!